Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. Today is August 4, 2025. This is the Northbound Wealth Weekly Market Insights podcast. Let's dive in. Retreat after data and heavy week. Stocks fell last week as investors assessed progress on trade negotiations, new U.S. tariffs, and fresh data on the U.S. economy. The S&P 500 index fell 2.36%, closing Friday's session at 6,238.01 as payroll data missed forecasts. The S&P 500 is up about 6.1% this year, and it rose 2.2% in July, its third consecutive monthly gain. The Nasdaq Composite Index declined 2.17%, closing the week at 20,650.13. The Dow Jones Industrial Average dropped 2.92%. The MSCI EFA Index, which tracks developed overseas stock markets, lost 2.95% respectively. So it's an action-packed week. Last week, stocks largely went sideways over the first half of the week as investors waited for more Q2 corporate results, fresh economic data, and the Fed decision. The U.S.-European Union trade agreement announced over the weekend had a muted impact on the market as the week began. Stocks then retreated as China trade talks appeared to stall, with the Dow declining the most of the three major averages through midweek. Stocks gained on Wednesday morning after the latest GDP report showed consumer spending powered the economy back to 3% annualized growth in the second quarter. That afternoon, the Federal Reserve announced that they were holding rates steady, which put some pressure on stocks. Selling pressures continued on July's Friday trading day as investors continued to fret about the Fed's next move. Personal consumption and expenditures index, the Fed's favored inflation metrics, showed a June uptick in core goods prices, unsettling some investors. Stocks were under pressure from the opening bell on Friday as investors sorted through fresh tariff announcements from the White House, a softer than expected July jobs report, and mixed second quarter corporate reports from two mega cap names. Materials led decliners last week, falling 5.4%, while consumer discretionary lost 4.5% and healthcare was down 3.9%. In materials, Eastman Chemical shares fell 25% as its second quarter missed market expectations, and UBS and Mizuho cut their price targets on the stock. Decliners in consumer discretionary included Caesars Entertainment, whose shares fell 13% as the company posted second quarter loss against earnings expectations. Utilities and communications were the only two gainers, climbing 1.5% and 0.01% respectively. Vistra had the largest weekly percentage increase among utilities. A lot of my clients have that one, gaining 8.3% as the company raised its quarterly dividend by 3% to 0.226, or a little over 22 cents a share. Raymond James increased the price target on Vistra stock to $241 a share, up from 216. Weekly market insights, major index return summary. I got a nice Y charts chart showing that, and you guys can check it out on the blog. The Nasdaq Composite Index over the past 1 year trailing is up 20.86%. Year to date, it's up 9.79%. S&P 500 1 year trailing number is 16.33%. And year to date is up 8.59%. These numbers are through Friday's close, so it doesn't include today's big gain. MSCI EFA Index 1 year trailing numbers up 13.35%. Year to date is definitely a leader outperformer, up 18.25%. Dow Jones Industrial Average over the last 1 year trailing is up 9.95%. Year to date, it's up 4.72%. All right, the 10-year Treasury notes trading about 4.23% as of last week, and that's down from 3 months ago of 4.25%. And 1 year ago, 3.99%. It's up about 6% from there. So keep an eye on that 10-year Treasury. We'll keep it coming on all this data for you guys as we head through the month of August. It's going to be hot out there, so try to stay cool. Mixed economic signals. There was a trove of economic data for investors to parse last week. First, there was economic growth. While 3% GDP growth in the second quarter is a solid step up from 0.5% contraction in Q1, consumer spending largely drove the increase, offset by slower business spending, especially investment in equipment and buildings. The PCE report shows why the Fed remains focused on inflation. Finally, Friday's job report pointed to a slowdown in hiring, a bit more concerning, and that's why the market sold off last week on Friday, especially. And it was revised lower. The non-farm payrolls rose by 73,000 in July, according to data released Friday by the Bureau of Labor Statistics, missing the consensus estimate compiled by Bloomberg for 104,000 increase. So it was a little bit lighter. The unemployment rate increased to 4.2% in July, in line with the market view. So it's not out of the ordinary. So it was, I think, a bit of an overreaction. The Fed has no meeting in August. Everybody seems to just take a break, take the month off in the government for August and start politicking around and positioning for the next 6 months, with 3 other meetings scheduled for 2025. That's what the Fed is going to be talking about, looking at just 3 more meetings over the next, 6 months. This week's earnings features Palantir, Advanced Micro Devices, McDonald's, Walt Disney, Eli Lilly, and Toyota Motors. And economic data will include the June trade deficit, factory orders, wholesale inventories, consumer credit, July S&P Purchasing Managers Index, and second quarter U.S. productivity. So we're going to be tracking all of that. Let's see. That about covers it on the market front. Let's dive into the tax tip of the week. What to know about excise tax as a business owner. Federal and state excise taxes are for specific goods, services, and activities such as fuel, tobacco, alcohol, airline tickets, and more. If your business is subject to excise tax, you must file a Form 720 quarterly excise tax return to report the tax. You must also file this form every quarter. You can electronically file Form 720. Each industry may have its own forms. For example, Form 2290, Heavy Highway Vehicle Use Tax. This information is not a substitute for individual's tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from the IRS. All right, moving on. We got a good show for you. Hello, everybody. This is Brent Foster. We're going to talk about a quarterly update on earnings. I thought we would highlight some stocks, first starting with Apple, then Amazon, Alphabet, Meta, and Netflix. And I want to thank JP Morgan for some of this information. They do a fantastic job on the research side. And so we'll highlight a few things. So Apple, unbelievable quarter in many ways, long-term focus on AI progress and near-term focus on pull-forward magnitude. So according to their note, Apple surprised investors with results that defied seasonal trends and marked a significant acceleration in total company revenue growth, iPhone revenue growth, as well as Mac revenue growth. Although there are specific drivers like China subsidies that can be attributed for some of the exceptional strength at the time, the acceleration of iPhone revenue growth with only modest help from pull forwards, as outlined by the company, is equally surprising, particularly for a quarter where historically the bigger concern has been consumers waiting for the next generation of iPhone product launching in the September quarter. However, even if pull forwards were a bigger driver of the strength in the quarter, Apple management put some of those concerns to bed with robust outlook for the September, which is the fourth quarter of 2025. So for mid to high single digit growth relative to typically guiding to low to mid single digit growth for the last 3 quarters, emphasizing the higher confidence that the management team has on sustainability of the momentum. Apple also managed to surprise on multiple other fronts, with the most notable ones including 1, exceeding investor expectations on services growth with 13% growth in fiscal third quarter and guiding to a continuation of similar growth rate into the fiscal fourth quarter. The backdrop of the perceived headwinds from link outs. Number two, guiding to tariff headwinds for fiscal fourth quarter to track 1.1 billion in September quarter versus 800 million in the June quarter, which in the backdrop of concerns around magnitude of the benefit from pull forward of inventory in the June quarter, it's better than investors expected and is leading to total company gross margin of fantastic 46 to 47%, exceeding investor expectations. Number three, a more aggressive tone relative to the ramp of investments and reallocation of resources towards AI, with the company guiding to ramp in CapEx as part of its investments in AI. We look forward to progress in relation to AI features, launch of personalized Siri, and investments in AI, including potential acquisitions. I love that they said that. They do need to do that. Will remain key watch points for long-term investors looking for Apple to compete effectively in a device landscape where expectations are largely for AI to be ubiquitous and to drive a potential upgrade cycle. However, on a near-term basis, we believe the upside on results and outlook will limit investor bearishness for the September quarter, but investors will continue to monitor if the pull forward hurts the momentum for the iPhone 17 cycle, along with monitoring the outcome of the DOJ versus Google lawsuit, which I will go over a little bit later, and potential changes in tariff rates and outcomes of Section 232 investigation. We are raising our estimates for fiscal year 2025 following the print, but keep a cautious view by incorporating moderate amounts of digestion for the iPhone 17 cycle, such that our out-year forecasts improve more modestly. We are raising our December 2026 price target to $255 versus $250 per share prior on our higher forecast. So they are upping it by a little bit, by $5. That represents about a 25% upside from here. So if you don't have Apple and you're looking to maybe expand to maybe allocate some capital towards that from an investor standpoint. A lot of my investors already have Apple and a significant amount, and they kind of just buy and hold and ride that one out. But if you don't have it, it's not a bad time to pick it up. I think there's, on the technical side, when I look at charts, it looks like there's upside, and looks like the analysts think that's the case too. But you know what? In my opinion, Apple really needs to execute on the AI front. And they traditionally, if you understand Apple, are behind when they deploy capital. They're a very cautious company. They take their time and make calculated decisions. I hope that Tim Cook can deploy some of that capital he's got sitting in treasuries, that cash, to acquire companies so that they can get that growth engine back and not just heavily rely on devices like the iPhone upcycles. So that's Apple. Let's move on to Amazon. Retail strength offsets lower AWS profits. It looks like JP Morgan continues to expect AWS acceleration, buying the pullback and reiterating an overweight of Amazon with a price target of $265 a share. And that's up from their $255 prior price target. So up another $10. And the price as of July 31st was $234. I'm going to look up the price right now because the markets are open. And we've got a $215 price right now, August 5th in the morning. So we had a bit of a sell-off over the last couple of days, but it provides a significant upside opportunity in the stock. So think about going from 215 to 265, and I actually see that happening. I think Amazon's going to crush in the fourth quarter, and that they'll report a great year. I think in the first quarter of next year. So let's look at them a little more specifically. According to JP Morgan's some of their research reports, I'm not going to go through all of it. There's a lot with these, but Amazon reported solid overall results with sales accelerating to 12%. FXN growth and operating income growing 31%. So that's got an 11.4% margin on it, both nicely above guidance and expectations. Stores performance was a standout, with Amazon navigating early tariff impact extremely well with no visible impact of lower consumer demand or higher prices. And in North America, and international operating margins were both above expectations on lower costs to serve, operate efficiencies, and healthy advertising. AWS revenue growth of 17.5% was either in line or with or slightly below recently rising expectations, though there was uh, likely more focus last um, on the report on AWS operating margin of 32.9%. It's incredible that they still have above 30% margins on that business. 660 bips below first quarter levels, which is a little, interesting. And we'll have to. I think it's because of competition. They have to keep lowering costs there and things like that. So Amazon remains optimistic that supply constraints will ease in the back half of this year, but stops short of projecting accelerating AWS growth, even as AWS has excess demand. So Amazon shares did trade down, as I said, and they're indicating that after the aftermarket, and they believe that it's a function of some Wall Street frustration over AWS growth, profit, and AI positioning, particularly in light of 30+% growth for Microsoft Azure and Google Cloud, even as AWS comes off a much bigger base. So I agree with that. Microsoft crushed it, and Google Cloud. It's just Google's got a cloud hanging over it with the litigation from the government rulings and things like that. So they should not be accelerating more than Amazon. It's like, I wonder if they're taking some business there. However, JP Morgan says they continue to expect better AWS growth in the second half of 18.5% in the third quarter and 19% in the fourth quarter, and overall estimates increasing out of earnings with higher store profits offsetting lower AWS margins. Amazon's valuation is heavily weighed by the AWS margins. So that is a number to really pay attention to if you're an Amazon investor. Our sales estimates increased 2% in 2026 and 27, while operating income and GAAP EPS go up 5 to 7%. We reiterate our overweight rating and would buy the pullback in Amazon shares. We are establishing a December 2026 price target of 265 on 29 multiple. So that's 29x on the forward multiple for 2027 of 27 earnings GAAP EPS of $9.12, which equates to about a 32.5x multiple on their 2027 earnings future forecasts of $81.4 billion, which is amazing. So there you have it. I think their shipping costs, early AI, Kuiper. If you look at that, Amazon views the second quarter cash capex of $31.4 billion as reasonably representative of second half of 2025 quarterly capex rate. So they're investing, they're growing, they're doing a great job overall. And so it'll be exciting to see how they develop over the next 6 to 12 months. All right, Alphabet, which is Google, latest thoughts into Judge's remedy. We remain bullish on fundamentals and would buy any remedy-driven pullback, reiterate overweight, and a $232 price target. So, and Google's currently trading at $197.78 a share. That's an interesting take as well. Like, you see the upside overweight price target is 232 in the next 12 months. And we're trading at 197. That's a nice increase if you're looking to gain exposure to Google and Alphabet. And the note goes on to talk about Alphabet in detail. I'll summarize. Alphabet remains one of the most debated stocks in the coverage universe of JP Morgan and actually, frankly, across the board. Recent investor discussions shifting the judge's impending decision on remedies in the search commercial agreement case, which we expect by August 8th. That's in 3 days. The exact nature and Financial implications of the remedy remain difficult to predict, and we believe this uncertainty explains the muted reaction in Google shares since the second quarter earnings, up 1% versus flat SPX, which is the S&P 500, following what we believe was a defining quarter. We reiterate our overweight rating on Google shares into the judge's remedy, and we'd be buyers on any remedy-driven pullback. So that's what JP Morgan's planning on doing, and I agree with him. I look at the technical chart, definitely bullish, definitely was not in great shape in April or prior to April, but since April, when Trump tweeted at like 9 or 10 o'clock Eastern on April 9th, it's been nothing but looking back. I mean, it was trading at 145. Now it's nearly 200 a share. And then they've got a 230, or $30, $32 to the upside, maybe a little more on that one. So I happen to agree. I hope they get this behind them. And I think knowing what the damages might be are going to help the investors re-engage the stock all the more. It says here, let's see, they believe the judge's remedy will provide greater clarity. And while investors are braced for a negative outcome, there's also potential for the remedy to be less punitive than expected. What would be less punitive? We believe the prohibition of exclusionary practices and preloading of Google search, i.e., no exclusive search default on any access point, and not much more. Regardless of the remedy, Google will immediately appeal the judge's initial August 2024 monopoly ruling and perhaps the remedy itself. And there is a potential for the remedy to become less onerous to Google via an ultimate settlement. We believe those possibilities outweigh the near-term risks, which we believe could be a 5 to 10% headwind to GAAP EPS. Furthermore, strong second quarter results with cloud growth accelerating to 32% year over year and AI search products increasing in scale without a notable air pocket in revenue, search and other plus 11, FXHN, and normalized operating margin excludes legal fees and settlement expanding to 150 bips year over year, support our bullish view on Google shares. Overall, Google remains a top pick behind only Amazon, as we remain positive on Google's AI leadership, including navigating the AI search transition. Number 2, solid search and targeted ad growth. Number 3, Google Cloud acceleration from strong demand and increased compute capacity. Number 4, margin resilience despite ramp in CapEx and depreciation. Number 5, attractive valuation with Google's shares trading at about 18.3 times their 2026 earnings GAAP EPS and 16.3 times our 27 earnings GAAP estimates. So they're reiterating. Okay, so talked about Alphabet, Google, that is. Let's move on to Meta. All right. So Meta's trading at $779 a share. Super quarter, super intelligence. JP Morgan maintains their overweight and price target. Let's see here. They updated their 2026 price target, $875 a share. So basically, about $100 higher than where it's trading today. Meta delivered very strong second quarter results and third quarter guidance as outsized revenue growth continues to support outsized infrastructure investments. It looks like second quarter revenue growth accelerated to 22%, largely due to AI-driven engagement increases and ad improvements. And the high end of Meta's outlook suggests further acceleration in the third quarter. As we've discussed many times in the past, Meta continues to earn the right to spend more on CapEx with strong core advertising performance. While the high end of Meta's 2025 CapEx is unchanged at $72 billion, the company indicated that it's likely to spend around $100 billion on CapEx in 2026 as it pursues its vision to bring superintelligence to everyone. We're impressed that despite a challenging Llama 4 rollout and major changes to the AI team, Meta did not miss a beat in its core ad business, which saw a significant acceleration in ad impressions to 11%. Additionally, we like that Meta's business opportunity set for AI ads, engagement, business messaging, Meta AI, and AI devices remains intact against the backdrop of Meta's improving engagement and monetization. We're increasing our revenue estimates 5% for 2025 and 7 to 8% for 2026 and 27. Overall expense growth will accelerate in 2026, keeping the bottom line in check. But our GAAP EPS earnings estimates increases 6% in 2026 to $31 and 2% in 2027 to $34, both of which could still be conservative. Our future cash flows is another story as CapEx weighs, and we now project future cash flow declines in 25 and 26 on elevated infrastructure investments. And JP Morgan are establishing a December 2026 price target of $8.75 based on 25.5 multiple of 2027 earnings, GAAP EPS of $34.14. So they go on to talk more in depth about their take on it. And from what I look at all these earnings reports as they happen, not just through JP Morgan, but through an app called Quarter, as well as Charles Schwab. They provide a lot of insight, as well as stock charts. And so I'm on top of it too, but I sure like to see what the largest bank in the world likes to say about some of this stuff. Okay, last but not least, and finally, would be Netflix. Red light, green light, yellow, executing well with guidance increase as expected. They say in their note, we continue to think shares need a breather, remain neutral with a $1,300 price target. So it's trading at $1,168.20. Is there another player dominating the space in streaming? In my view, I don't think so. There's nothing even close. And Netflix has emerged as the 800-pound gorilla in the space. And I think they will continue to be. It's going to be hard for most of the legacy media companies to challenge what Netflix has accomplished and done. So kudos. Well done, Netflix. Let's look at Netflix. Second quarter results and forward outlook were solid against high expectations. The quarter overall was fairly straightforward as Netflix continues to execute well across content, member growth, and advertising with incremental boosts from FX and a weaker USD, which is dollar. Let's see. Netflix raised its 2025 outlook to $44.8 billion to $45.2 billion. That's up $1 billion at a midpoint operating margin of 29.5%. That's up 50 bips. And future cash flows of $8 billion to $8.5 billion. That's up $500 million on the high end. Netflix continues to progress towards becoming the global TV over time, and we believe the company is well positioned into the second half, given strong content led by Squid Game, season 3. Let's see, Wednesday season 2, and Stranger Things season 5. Advertising execution is picking up, supported by the rollout of Netflix Ads Suite and 3P DSP partnerships with Netflix, deepening monetization on track to roughly double advertising revenue in 2025 on a near-term basis. Sell-side consensus numbers will move higher, but buy-side estimates are likely unchanged with no meaningful shift in overall narrative. Our 2025-2026 estimates increased by 1% for revenue and about 1 to 2% for operating income. We remain neutral rated, and we are establishing a December 26 price target of $1,300 based on 36 multiple 2027 earnings GAAP EPS of $36.13 and 39.5 multiple of 2027 earnings, future cash flows of let's see, $13.9 billion. And looks like all their calls with management is all very well done. They communicated well. Management seems to understand their structure. They are well positioned going forward. And I look at the chart on Netflix, and it's down since that earnings report, since end of June, early July. It was at $1,350. So a $1,300 price target technically was already reached. We've had a sell-off, a lot of people taking profits, but when I look at the chart and I look at the Fibonacci retracements, It's in an orderly corrective pattern, and then likely forming up a new base to then trend higher over time. I would not be shocked if Netflix just crushes it the remainder of this year. And so reporting earnings, say fourth quarter earnings for 2025, doing that in the first quarter of next year of 26, if they don't have any miscues, their stock price will be ratcheted higher as time goes on. Given macro backdrop, it should be fine. All right, so we went through Apple, Amazon, Alphabet, Meta, and Netflix. Thank you. I want to shout out JP Morgan. They do a fantastic job. All of the analysts and the teams there in research do a great job. I also interjected my thoughts and summary, and I think it's worth owning. I think the majority of my clients have all those companies. It's just at different price targets and maybe entries, and so I'm excited. All right, that'll wrap up this week's Market Insights, Northbound Wealth Management. If you have any questions or want to talk to us, reach out to us at 317-399-1107 or check us out on the website, www.northboundwealth.com. You can send us a message through Contact Us page. Check out the blog, follow us on socials, and we'll go from there. Have a great week and weekend.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.